So let us now look at some other measures of capital budgeting rules. So one such popular measure is what is known as internal rate of return. Now, this often actually leads to the same recommendation as the NPV criteria, but the philosophy of this method is a bit different. So it's worthwhile looking at it. Okay. So what the internal rate of return, which we often abbreviate by IRR, does is that it compares the project's rate of return to the prevailing rate of return in the economy. Okay. So let's take a particular example to see how this works. So assume that you have a project with cash flows that translate into a rate of 15%. So an example would be, for instance, if you have an investment of 100 today, and that leads to a payoff of 115 next period. So we can see that the rate of return for this project is 15%. And now suppose that the interest rate prevailing in the economy is 10%. Since you are getting a better return from the project than the interest rate that is prevailing in the economy, then intuitively we should actually take up this project, right? And actually, if you do the NPV of this project as well, which would be minus 100 plus 115 divided by 1.15, you can also show that that is positive, and hence NPV criteria or the NPV budgeting rule would also say that you should take up the project, right? So that's pretty simple to understand here. But now we want to actually kind of like use the same idea of comparing the rate of return of the project to the prevailing economy in more complicated cases, right? So let's take a look at this example. So imagine that you have an investment that costs 1 lakh today and pays off 5,000 in 1 year's time, 10,000 in 2 years, and 120,000 in 3 years' time. Okay. Now you can see that here, if you want to use the same method that we did in the previous example, where we calculated the rate of return and then compared it to the prevailing economy, that's not that simple to use here, right? Why is it not so simple here? Because you have got basically the payments which are in multiple time periods rather than just in one time period, which is what we have been dealing with so far when we are calculating the rate of return, right? So what this means is that we need to actually extend this concept of the rate of return to a situation where you may have potentially many inflows and many outflows. Okay. And ideally, we want to have this new measure of rate of return give the same number as the simple rate of return that we have been talking about if there is only one inflow and not one outflow, right? But we want to also make sure that it can also be used in cases when you've got many inflows and outflows. So the internal rate of return is actually one such measure, right? And so what this suggests that it should give us the same answer as the usual rate of return when we have only one inflow and outflow, but it should also take into account this case where you've got multiple inflows and outflows. Okay. Now, this is often used in the context of bonds. And then in that case, the internal rate of return is also known as the yield to maturity, a term that you might often hear in the bond market. Okay. So what do we actually find? So remember, if there's only one inflow and outflow, the IRR is actually the same as the simple rate of return. So imagine that you have a project that costs 100 units today and pays out 120 units next period. So how do we calculate the IRR of this project? This will be done by solving this equation, right? Minus 100, which is the cost today, plus 120 divided by 1 plus IRR, and you set that equal to 0. Okay. So now if you do the algebra, you can show that this will lead to IRR being equal to 20%. Okay. So it makes sense, right? So we basically have, if we have something that costs 100 today and gives out 120 next period, that is equivalent to a return of 20%. And the IRR also gives us this method, right? But notice how we solved it. So we set up this equation where we had the cost today plus the 120 divided by 1 plus IRR equal to 0. Notice that nowhere did we use the actual rate of interest that is prevailing in the economy. So this is one important characteristic of IRR, that this is actually a characteristic of the project and not of the situation that is prevailing in the economy. Okay, so this is one thing to keep in mind. Okay, now let's come to the more complicated case for which we actually needed this concept of IRR. So imagine that you have got investment which costs 1 lakh today and it's going to pay off 5,000 in 1 year, 10,000 in 2 years' time, and 1,20,000 in 3 years' time. Okay. So how would we characterize this implied rate of return for this project, right? So intuitively, if the discount rate is very low, then the NPV should be positive of this project, right? How do we see that? So imagine that the discount rate is very close to zero, right? Then basically, whenever we are discounting anything in future, that's the same as the cash flow, right? So what this means is, for example, suppose R is very close to zero, then 5,000 divided by 1 plus R is the same as 5,000. 10,000 divided by 1 plus R square is also 10,000, and 120,000 divided by 1 plus R whole cube is also 120,000. Of course, this requires R to be very close to zero, right? But as R keeps increasing, you would expect that basically at some point the NPV is going to become negative, right? Because then the future kind of payments that we are receiving are going to be discounted more and more, right? So what we are looking for is pretty much the point at which the NPV becomes exactly equal to zero. Okay. So IRR is basically the interest rate that makes the NPV exactly equal to zero. And so what this means here is that you need to solve for this equation. Okay. So we have got a cost of 1 lakh today. We are getting 5,000 1 year from now. So we need to discount that by 1 plus IRR. Okay. Plus 10,000 in 2 years time. So 10,000 divided by 1 plus IRR square, plus 120,000 in 3 years time. So 120,000 divided by 1 plus IRR to the power 3. And we want to set that equal to 0 and solve for the IRR. Okay. So it's almost the same as the net present value formula that you saw, except for the fact that we are replacing the interest rate with IRR. And we are actually setting the net present value equal to 0 and then using that to solve for the value of IRR, right? So if you go ahead and solve this equation, you are going to get that the IRR is going to be equal to 11.14%. Now, one thing is, this seems like a much more complicated expression, right? And it will become even more complicated if you have payments out in the fourth, fifth year and so on, right? So how do you go about solving it? So one way of doing it is that you can try trial and error, but that is also not going to be practical. So you have to often kind of have to resort to computer programs or softwares. So most spreadsheets have actually formulas to calculate the IRR already built in. So for example, if you are using Excel, you can look up the IRR function, right? And like the other programs would also have something close functions, right? Okay. So you can actually put in this cash flows at different points and use the computer to come up with this number. Okay. So one interesting thing to note about IRR is that if you have projects which have many positive and negative cash flows, then they can actually have multiple internal rates of return. Okay. So let's take an example here. So imagine that you have a project that costs 1 lakh today and pays 205,000 1 year from now, and then has a environmental cost of 102,000 2 years from now, right? So you have to again kind of spend some cost to clean up the site of your activity, let us say, after you're done with the project. Okay. Now, it turns out that this project actually has got two different internal rates of return, right? Minus 15% and 20%. So in order to verify that, you can actually plug in this cash flows, right? So minus 1 lakh plus 205,000 divided by 1 plus minus 15% plus negative of 102,000 because this is a cost. And then again, if you divide 1 plus minus 15% square, okay, and then if you calculate this expression that you see here, you're going to end up getting 0. Okay, so that proves that minus 15% is a IRR. Okay, and similarly, if you actually do the same expression, but instead of minus 15, you put in 20%, you can also show that that too is also equal to 0. Okay, so what that means is that both minus 15% and 20% satisfy the definition of IRR, and in fact, they are both IRRs here, right? And in fact, that's not just the end of it. In some cases, you can actually end up having more than 2 IRRs, right? So the issue is that when you are doing IRR calculation using computer spreadsheets, for example, the command that we mentioned in Excel, they may not actually give you more than one IRR, even if multiple internal rate of returns exist, right? So this is one limitation of using the software that you have to be aware of. And typically, one way of kind of like thinking about it is that instead of kind of like putting in a particular value, let's say you put in a value X here, where X is the IRR, and then you can see how this NPV is behaving as you are changing X, right? And so basically every time it hits the zero, you have a solution to this IRR, right? So by looking at that graph, you can actually have some idea of how many perhaps can you have, right? So it's not enough to just rely on the computer. Okay, so just as we can have multiple IRRs, in fact, you can have a situation where actually you have projects which have no internal rate of return, right? So, for example, consider a project that is going to give out 100 today and 200 in the next period. Such a project clearly is not going to have any internal rate of return because you can never find values of um, the IRR such that this NPV formula is equal to zero. Okay. So to take a less trivial example, consider a project that has a cost of 10,000 today, then pays out 27,000 in 1 year, and finally requires a cleanup cost of 20,000 in 2 years. In this case, also you can show that there's no rate of return at which the NPV of the project would actually turn positive. Okay. So again, it has no IRR as well, right? So good news is that usually if you do not have any IRRs and you input in these numbers, the computer spreadsheet often would actually give you an error if no IRRs exist. Okay. So can we be then sure that a project has a unique IRR? Well, in a couple of situations, you can be sure. So, for example, if the project has one negative cash flow followed only by positive cash flows, then the project has one and only one IRR. Okay. And similarly, if the project has one positive cash flow followed by only negative cash flows, then also the project has one and only one IRR, right? So those are the two situations where this works. Okay, so how can we use this concept of internal rate of return to come up with a capital budgeting rule? So here we need a rule which specifies whether a project should be taken up or not. And the way it works is that we need to calculate first the project's IRR, okay? And then we need to compare it with the appropriate discount rate prevailing in the economy, okay? So if the IRR of a project is more than the discount rate prevailing in the economy, then the project should be taken. If it is less, then the project should not be taken, okay? So in this case, the interest rate that is prevailing in the economy or the cost of capital, that is often known as the hurdle rate. So basically, then the capital budgeting rule for IRR is often summarized as saying that if the IRR of a project is above the hurdle rate, then one should take up the project. If it is below the hurdle rate, then one should not take up the project, right? And in most of the cases that people actually encounter, this IRR capital budgeting rule often gives the same answer as the NPV capital budgeting. However, if there are no or multiple IRRs, then it may not give the same answer as the NPV capital budgeting. So let's take an example to see how this capital budgeting rule works. So imagine that you have an investment that costs 1 lakh this year and pays off 5,000 in 1 year, 10,000 in 2 years, and 120,000 in 3 years. So this is the example that we had seen before. And we had found that the IRR was 11.14% approximately. Now, the IRR capital budgeting rule would say that, for example, if the prevailing cost of capital in the economy is 11.25%, then we should not take up this project because the IRR of the project is actually below the cost of capital in the economy. However, if the prevailing cost of capital is, for example, 11%, then we should actually take up this project because the IRR is more than the hurdle rate, which is 11% here. Okay. And actually, if you do the and calculate the NPV of this project with this cost of capital, you can see that the NPV would also give you the same recommendation, namely that when the cost of capital is 11.25%, the NPV of this project is negative. Whereas when the cost of capital is 11%, then the NPV of this project is positive. Okay. Now, interestingly, the IRR can also be used if the cash flows have the opposite kind of signs, where you have got one upfront positive cash flow followed by several negative flows. So this would more be an example of kind of like an investment financing, where basically you are getting in money first, and then you have to pay out to your basically the parties which financed you, right? So this would, for example, be a case where you receive, let's say, 1 lakh upfront, and then you have to pay out 5,000, 10,000, and 1,20,000 in 3 successive years, right? And actually, if you do the calculation, since this is exactly the negative of the previous case, so the IRR will also be the same as before. So which is going to be that it is going to be 11.14%. But what changes is the capital budgeting rule, right? So now the capital budgeting rule would in fact be the opposite of the previous case. And it would say that you should take up this financing alternative if and only if the prevailing interest rate in the economy is above 11.14%, right? So remember, in the previous case, when first you were spending this money and then you were getting money, the rule was that you should take up this project only if the IRR is more than the prevailing rate in the economy. If now you are the one who is receiving the money and then paying out in later years, this capital budgeting rule is reversed and it says that you should take up this project if and only if the prevailing interest rate in the economy is above the IRR. Okay, so this is one important thing to keep in mind, that depending on the cash flows, okay, you have to kind of like think about how to apply the capital budgeting rule. Okay, so why do kind of like people use IRR, right? Because it seems that, already you had such a nice criteria as the net present value. Well, one major usefulness of the IRR is that it's only a characteristic of the project's cash flows, right? And so what that means is that it does not particularly depend on the interest rate that is prevailing in the economy. So the interest rate that is prevailing in the economy only becomes important when we are looking at capital budgeting decisions using the IRR. However, the IRR can be used for other things rather than just looking at the capital budgeting rule, right? So major advantage to compute the IRR of a project, you don't have to look at financial markets, interest rates, or any cost of capital. So you can just independently think about judging the project profitability. And you can also use this to assess the performance of a manager, right? So a manager or a project which has a higher IRR would seem to be kind of like better than the one that has a lower IRR, right? Comparing the IRR to the cost of capital can also help you to understand how much buffer one has in terms of getting one's cash flow estimates wrong. By certain percentage points without the error affecting the investment decision, right? So, for example, suppose that you had that the IRR of a project was around 10, whereas the prevailing interest rate in the economy was 5. So even if you had got some of the cash flow estimates wrong, as long as the IRR of the project remains above this 5%, then you would still make the same investment decision, right? So, for example, in the first case, it would have been, you should take up the project, let's say. So that gives you an idea of how much buffer you have in terms of getting your estimates wrong and still not having the investment decision being affected. Okay, so those were the good things. What are some drawbacks? Now, IRR actually works well only if there is one unique IRR, okay? And it is safe to use whenever you have got only one positive or only one negative cash flow. However, you need to make sure that you are applying the capital budgeting rule correctly, right? So remember that if you have a negative cash flow followed by positive cash flows, then the IRR would be take up the project if the IRR is more than the hurdle rate, right? Whereas if you have positive cash flow followed by several negative cash flows, then the capital budgeting rule reverses, right? Okay, so this is something to keep in mind whenever you are using it, right? The difficulty is that it's very difficult to implement this capital budgeting rule if you have got multiple internal rate of returns or no internal rate of returns, right? In that case, you have to rely on the graph of the NPV function to see is it like forever positive or forever negative if you have no IRRs, or if you have multiple internal rate of returns, then you need to figure out, by looking at the graph of the NPV, that is it worthwhile to take up the project at that particular rate, right? Another difficulty is that, remember, we are actually comparing the IRR of a project to a cost of capital, right? But if you have multiple costs of capital, and this is something that we are going to discuss later when you have got multiple interest rates, then it becomes hard to think about whether we should compare the IRR of a project to a short-term interest rate or a long-term interest rate, right? So then we have to take a stance where it is, and you may have different recommendations of the capital budgeting rule depending on which interest rate you compare with. The other thing that is interesting is that the IRR criteria can be potentially misleading whenever you have got projects which are mutually exclusive, right? So let me give you an example of that. So conceptually, you would imagine that one should actually prefer a project with 100% IRR compared to a project with 10% IRR, right? Why is that the case? Because intuitively you might reason that, okay, suppose I have to choose only one among these two projects, right? And if I have to choose only one, which one should I choose? That is the question, right? So you might think that, okay, it's perhaps worthwhile to actually uh, choose this 100% because, for example, if the economy's prevailing rate is 40%, then it is still the IRR of the project is still above the hurdle rate, right? Whereas this would not be the case if the IRR that you took was the one which had 10%, right? So you would think that in more cases, it makes sense that a project should go ahead because it is likely to be above the interest rate. But let's look at the following example to see that this is not necessarily the case, right? So imagine that you have a economy with a rate of return equal to 5% per annum. Okay, so that is the cost of capital. You have got two projects. Project one is an investment opportunity of 5, where you have to incur a cost of 5 this year, and that's going to return 10 next year. Okay. And project two has an investment opportunity of involving 1,000 cost today, and it returns 1,100 in 1 year's time. So if you now calculate the IRR, so it's pretty clear that in the first case, the IRR is 100%. And in the second case, the IRR is actually 10%, right? So as per your intuition in this case, you would have thought that you'd prefer the first one to the second one. However, if you calculate now the net present value, you will see that in the first case the net present value was only 4.52, whereas in the second case the NPV was 47.62, right? So this would suggest that if you only have to take up one project, then one should actually take up the second project, right? So this is another example where basically, in cases where you have to choose only one project among a set of projects, then using the NPV to select which project to choose is a much better idea than to actually choose the internal rate of return. So this is again some example to keep in mind when you are thinking about what are the possible drawbacks of using IRR as a criteria to decide among projects.